and welcome to our latest 7 Investment Management teleconference. Our aim today, as ever, is to spend half an hour going through our latest views on the most recent meeting of our asset allocation team. I'm joined, as usual, by Ros Price, our Chief Investment Officer. Morning, Ros.
Morning.
And number 2, Senior Investment Manager, Alex Scott.
Hello.
So, Ros, first of all, we can start with you. It's been a quiet summer. What's been going on? Has the situation in Europe improved and fear of the euro collapse abated since Q3?
I think that's right, it has. We've all been used to very dramatic summers over the last 4 or 5 years, and this year we were all given August off. For that we can thank Mario Draghi. We did start in July, in the middle of July, to have the usual summer attack on all things European, bond markets and equity prices. Bond yields rose, equity prices fell. Now Mr Draghi, who was over here in London for some conference or other just ahead of the Olympics, announced to a rather startled audience that the ECB would not permit the euro to disappear and that the ECB would do everything to preserve the euro. And then he added the comment, and believe me, it will be enough.
And there seemed to be a lot more confidence in that this time.
Well, we all know that old adage, don't fight the Fed, and it applies to the ECB just as equally so. It is a major central bank.
Can I just add here, we have actually sent out access to slides for listeners. So if you want to go through that, I'll try and highlight the particular slides that may be relevant at the moment. Probably looking at slide 2 here, Euro risks recede. Ros, are there any other issues on this?
Yeah, quite a bit has happened over the summer, actually. We've had quite a lot of elections. The Greek elections in particular were supposed to bring to power a bunch of anti-Europe, going to leave immediately types, and oddly enough it didn't. Since then, in actually September, we had the Dutch elections where again, 6 weeks before the election, it was going to be all the Eurosceptic parties were going to will and they were going to put the mockers on everything. No, it didn't. The Constitutional Court in Germany did not blackball efforts to support the euro via the ESM. The ECB, obviously, with its OMT, bought a huge amount of time for people. And in the background, oddly enough, all the reforms have started to pay out a bit.
It's interesting, when you look at slide 3 there, you highlight that unit labour costs in Spain have already started to come down. And can that be mirrored in some of the other countries as well?
Certainly can. Portugal, Spain, even Italy. Actually, the country that hasn't seen much improvement in unit labour costs is actually not in the euro and is the UK.
OK, let's move on. Alex, there's been a whole new alphabet soup coming out recently of endless initials. It took me a while to try and work out, such as the ECB's OMT and the Fed's QE programmes. These seem to have had a mixed reaction in the market. What's your take on this and how are we managing it? I think this reference is actually on slide 5 here. There's an amazing list.
Yeah, there is. I mean, this is just a list of the bond buying and QE type programs undertaken by central banks. There have been a whole lot of other central bank support programs as well. So I think this continues the trend we have seen over the last few years of central banks providing increasingly strong and increasingly unconventional support for economies and for markets. But I think what's really interesting about the latest programs we've seen, the Fed's latest QE program and the program from the ECB, the OMT, which essentially allows them to buy bonds of struggling peripheral debtors who ask for bailout and ask for support, is that these programs are increasingly unlimited or open-ended in their nature. And that's really significant, both in terms of reducing the risk of a major accident in markets, taking off some of that tail risk which was hanging over markets perhaps earlier in the year, but also on the more positive side, in terms of what they do for providing liquidity to markets and to the economy to support growth, to support risk-taking activity, whether it's by investors or whether it's by companies, and in how these measures are targeted as well. I mean, in Europe, as Ros says, with the statement from Draghi, President of the ECB, these measures very much targeted at convincing markets about the future existence of the euro. Of course, we can worry about growth and how fast or how slow that's going to be, but these measures should dramatically reduce those existential fears about whether there was still going to be a euro. Those should be dramatically reduced here. And in the US, of course, we've had these measures much more strongly targeted at supporting the housing market, and we've been told they're going to stay in place until the labour market as well has significantly and meaningfully improved. So much more targeted.
This is a very long list, but globally linked as well, isn't it? It just looks as it's being coordinated together.
Yeah, I mean, whether it's coordinated or whether it's competitive, in some ways doesn't matter. What we are seeing is the major central banks around the world, you've got the Bank of Japan on this list as well, of getting involved in QE and other supportive measures. They are taking increasingly positive and increasingly meaningful steps.
Okay, global growth is still very much a key concern. The good news is there's still global growth, isn't there? Coupled with the risk of further slowdown in emerging markets now. Ross, is this set to continue? I think on slide 6 it actually shows there that actually growth is still come down a lot, but still there.
Well, one of the things we've forgotten in all the horrors that we've gone through on the credit crunch is that there is this thing called the economic cycle, and it still exists underlying all. And we had an amazing pickup, perhaps, from the bottom of things in 2009, and we have got a shortened cycle, perhaps, and therefore it's turning down. The latest forecasts, I think, if people read them from the IMF, they gave out their world economic forecasts the other week. They were a little gloomy, and they were suggesting that growth in the US would turn down a little bit. They were much more bearish on Europe and suggest that Europe will stay in recession for some time, which is understandable given the turmoil in sorting things out there. And the UK's growth outlook was sort of flat to average. The possible problems, slowdown in China, they didn't think would happen too much, but if it did, they thought that that would drag the rest of the emerging economies down.
But global growth of around 3% is the long-term average anyway, isn't it?
Well, it is. I think people got used to the idea that global growth was going to be 4 to 4.5%, and that's fine at the peak of the cycle, but it's not fine, particularly when it's a credit-driven splurge. It's not normal.
Alex, in developed markets, the US is obviously recovering quicker than Europe, which is important as it is the key driver for the global growth. But it looks as though the US is recovering much slower than normal, and new worries are now focused on the impact of this fiscal cliff. Can you try and explain what this fiscal cliff is, simply, and its apparent consequences?
Sure. I mean, the fiscal cliff, if you like, is a catch-all term to describe a range of tax cuts or tax breaks that were put in place in previous downturns in the US, and a range of spending cuts that will come through, that are automatically going to be implemented at the end of this year, if agreement is not found to prolong those tax breaks. So, we know the US has got debt problems of its own. The US has got a large amount of debt. It's got a high annual deficit. At some stage, it needs to address that. And looking at these tax breaks and looking at these spending programs is part of that. The problem we've got, and the area that creates this so-called cliff, the risk of brinkmanship between politicians leading us into some kind of disastrous outcome, is that if agreement is not found, if compromise is not found, and we know that could be difficult in a politically charged, polarised atmosphere, then we're looking at really quite significant tax hikes coming through, or as these tax cuts expire, and at spending cuts coming through. And that presents really quite a strong headwind to the US economy if we don't find that compromise. Now, I think most commentators, most economists are expecting some kind of sensible compromise to come through that'll put a bit of a dampener on US GDP growth without pushing it into disastrous territory. But there is a risk that those entrenched polarised views lead us into a more dangerous situation. Okay,
but following on from that then, are there any particularly positive trends emerging in the US? I think probably also taking into account the elections coming up as well.
Sure, there really are, and I think one of the really interesting areas in the US is what's happening to housing, to property markets in the US. And we've always looked at that as the root or the epicenter of the financial crisis that started to unfold in 2007 was about an overinflated US housing market with too much debt attached to it. And when that bust, that bust affected all of us across the world and led to problems in all sorts of other places. So what we've seen over the last year or so is we've seen stabilisation in US housing, and more recently, I think really quite encouraging signs, not of stabilisation but of recovery, of house prices rising, of transactions, buying and selling houses, that activity picking up. more lending on houses, more house building going on. This whole broad area of the US economy really starting to pick up, and I think that's got quite wide implications.
Not just for housing, but
not just for
broader
housing.
consumer.
Absolutely, for the broader consumer. So more spending on those durable goods, you know, the fridges and freezers that are bought when people move houses. A broader wealth effect from house prices rising and the owners feeling good about it, or perhaps feeling less underwater or moving back above water on mortgages that might have been in negative equity. So there's a pretty broad-based impact, I think, potentially from here, plus all those construction jobs that potentially come through from it as well. So we're watching this very closely as a positive sign.
Ros, let's move on. All eyes are on China at the moment as one of the key engines for global growth. What is your outlook for growth in China and its repercussions around the world?
I think that we need to get used to the idea that we've had very dramatic growth in China over the last decade, 10, 11, even maybe 12% for GDP. In aggregate, China is now the world's number 2 economy, and it cannot really grow at those levels. It is now developing and has become much bigger. You think about it, it's easier to go from 2 to 4 than it is from 10 to 20, and it's as simple as that. But it will continue to grow, but we need to remember that whilst we're all busy staring at the election in the US, we have a change in China as well of their government and leaders, and we're not entirely sure what we're going to get. We have removed the problem of a potential Maoist there with Beaujolais' fall, but we're not entirely sure either, therefore, what type of policies they will adopt. We think and we expect that they might actually focus on increasing domestic consumption and maybe focus less on the export-driven growth that they've had. And maybe we should say that an average rate of growth for an economy in this stage is going to be about 6 to 7% per annum rather than this 10 to 12.
And that's probably more sustainable.
It should be a lot more sustainable. And we need to look at the per capita GDP growth to see how the individual Chinaman improves his lot. There are implications, of course, if they stop building quite so many roads to nowhere and bridges to everywhere. Demand for a lot of commodities may drop, so the impact on other countries could be felt. So less commodity imports.
So countries like Australia, but also potentially the FTSE 100, which is so dominated by so many extractive companies.
Exactly. You know, they might need a little less copper. They might need a little less coal.
Let's move on then. Well, just one other thing on this. We were talking about when you were putting the papers together for asset allocation, you had one part title of it called The Tempest, which was to highlight what could go wrong and what could we do about it. On slide 12 there, you've got actually quite an interesting selection of the horrors that could occur.
Yes, what could go wrong? Well, all sorts of very unpleasant things could happen.
That's cheery.
But they might not. And, you know, you've got to think about the probability of these things happening. And I suppose perhaps the most probable thing that I would worry about is the unexpected hard landing in China. This could happen just because the new administration takes more time to become embedded and implement its new policies. So instead of arriving in December and having things done in January, they don't do things till June. It's as simple as that. That would affect global growth because it was, as I've just said, about the other dependent economies on the Chinese growth story.
So what could we do in case any of these things did occur?
Well, as you just mentioned, the thing to do there is to make sure we have less of an exposure to the mining stocks and the commodity producers of this world. So we would lessen those areas. The probable fallout from Europe, we actually don't think that's a very likely thing, but it is a very favourite story in the markets, and therefore we can talk ourselves to this. Headlines saying Euro to break up in 3 weeks leads to a lack of confidence that Alex was talking about they need in the US. This means that people, instead of spending money that they might have earmarked for spending, they sit on it in case it all goes pear-shaped and they lose it.
So if we can get a bit more confidence back in, then things may start to change.
Yes.
Well, let's look at then the more positive side. Alex, on slide 13, you've got a nice headline there. What could go right?
Well, I think our main kind of core view of the world is one on a lot of areas of things making continued gradual progress, two steps forward, one step back. I think when we look at some of these areas, there's just the possibility of 2 or 3 steps forward without the step back. So some of these existing trends accelerating or going a bit further than perhaps we think. So when we look at what central banks are doing, we think that the really effective measures from central banks have bought time from markets. They've helped to placate some of the market concerns, and that's bought time for politicians to make the reforms and make the developments that they need to make. The question is, are they going to use it widely? Are we going to see the continued muddle through? Well, yes, probably. But there is just the possibility that we see a step change in attitudes, that we see much greater developments on the roadmap for the future of Europe and how political and fiscal integration could look in the next decade or two. If we see progress there, I think that's potentially very, very positive for how the world looks at Europe and Eurozone assets. Again, looking at the US, we've talked about the scope for recovery in housing there. At the moment, we're seeing encouraging signs, but that could go deeper, it could go broader, it could gather momentum and be very, very positive for US growth and the impact that the US can have on the rest of the world if we see domestic demand, consumer-led demand in the US picking up as well. Ros mentioned competitiveness of the periphery, the Spanish unit labour costs around Europe and the improvements we've seen there. That's really encouraging signs, but I think there's a lot of focus as well on what Germany's going to do. Are we going to see German wages picking up after a fairly stagnant decade or so? If that comes through, that's great for the relative competitiveness of the rest of Europe, and it also gives scope for those German consumers to open their purse strings and start seeing a rise in German domestic demand. And these confidence issues around companies as well. If we see the clouds clearing and people worrying less about some of the tail risks that are out there, some of those spending plans and hiring plans that companies have perhaps been deferring or sitting on through the cloudy environment of the last 6 or 12 months, more of those coming through could be an extra bonus for growth as well.
Because we have seen quite a lot of cash being built up by corporates in America and Eurozone and, of course, here in the UK.
Absolutely, and economists and strategists have been pointing to these cash balances that companies hold for a year, 2 years or more. And it remains the case that companies are in pretty good shape. What we've always been concerned that they lack is the confidence to actually go for it. We're not putting a high probability on that really coming through strongly at the moment, but it's not that implausible. If we see this confidence build, then we can see some scope for those to come through, and that's a real potential source of an upside surprise that the market's not looking for.
Ros, on slide 14, we've actually got your key scenarios. What are can you talk us through those scenarios and the percentage weighting you put on those?
Yes. I think you'll see that we're down to 3 scenarios. We've combined the 2 versions of muddling through we had in the summer into one, which we've called As You Like It. So those of a bearish persuasion can be bearish about it, and those of a very positive persuasion can be positive. And we have 65% on this version of muddling through. We see in here a continued reduction of these near-term risks around the future of the Eurozone, helped out both by ECB moves and the continued moves towards integration. We expect to hear something on the roadmap to integration by Christmas, and it's going to see more structural reform, although it's still a muddling through scenario. Central banks will maintain their strong support for markets, preventing more deterioration. We can probably get some more alphabet soup out there before we're finished. We're also in this assuming the fiscal cliff is actually negotiated without any problems, and so that is a big positive for the US. In emerging markets, we think that there will be increased domestic consumption measures which will boost growth, and that will in turn support global growth. Then corporate earnings, which are all right so far, will continue being pretty okay. We see a falling rate of growth in earnings, but we do not see a negative earnings outlook for companies.
You definitely sound more on the positive end of the As You Like It.
Oh, I am, yes. I certainly am. But there are a lot of people in the market who, dismal Jimmies are out there. Well. The one thing that I find the most difficult in this is the sensitivity to politicians and their doings and sayings, which, of course, they're people, and it's very hard to second guess what politicians will do, apart from anything to be re-elected.
Okay, well, let's move on then and just look at the asset classes then. Which of those do you think are looking more attractive this quarter?
Well, we have felt for some time that the equity class is the more attractive going forward over the longer term. Particularly, we felt that Europe was undervalued in some of the emerging and frontier markets. Eastern Europe, we felt, had been much neglected. And that is an area which we have favoured and actually added to since the Draghi comments, really, in the summer and the beginning of September.
And on the bonds?
Bonds, we still feel that government bonds are in a very strange situation, probably technically overvalued. We are underweight gilts. We like credit and we like high yield still. We still feel that there is a little more to go for there. Let's face it, some companies have a better credit rating than the countries they're in. So that's why we like those.
And quite neutral on cash.
We're relatively neutral on cash, and we're actually beginning to warm a little to global property.
Right, that's been a change. And on the alternative side as well, adding to gold, is this a personal issue? I'm just judging by what you're wearing.
Yeah, I've been trying to persuade my husband that I really don't have enough gold for wearing, but we've added a little to gold, but then we're not in the gold bug class where we have, great sections of the portfolio in gold, but we have added a little to gold, possibly as an influence. It's really an uncertainty hedge in my view, just in case Syria brings the whole of the Middle East up in flames.
Okay, and foreign exchange, always a crucial issue in terms of actually the impact it can have on returns. What are your views there?
Well, we've actually reduced our euro hedge position, where we were virtually, in portfolio terms, 100% hedged. We're not now. And we are neutral on the dollar.
Okay. And Alex, which asset classes do you think we've reduced exposure to?
Well, I think the major changes in our portfolio have been in some of the alternative asset classes, where really we're looking at what we see as quite a difficult environment for some of those strategies to operate in. So for hedge funds, we've reduced exposure. I think managers are facing quite a tough time there in terms of how high correlations between stocks are at the moment. It's quite difficult for them to pick out the relative winners and losers in what are very macro-driven, politically driven markets where it's the risk-on, risk-off trade, things moving together very closely. That, we think, is quite a difficult environment for hedge funds. And the other side of that, on CTAs, we've also cut exposure, come out of the strategies altogether, actually, where we know that CTAs can prosper when there are strong trends in markets. They don't mind which asset classes, they don't mind which direction those trends are developing, but they need strong trends to be developing and to be able to get into those trends and exploit that momentum. And the problem is, of course, that in these very politically motivated, range-bound, choppy markets that we're living in at the moment, it's quite hard for them to see those trends and get into those trends to be able to exploit them.
And Alex, a crucial question from everybody is, at what stage does this issue with gilts and bonds reverse with the yields having gone down?
Sure, well,
what should we be looking for?
The question is, the answer is it resolves at some stage. We don't think it resolves yet, but I think a couple of points to note. We are underweight on our government bond positions altogether. We have some of those positions in shorter maturity bonds, which are less sensitive to a rise in yields when it does come. I think in terms of what drives a rise in yields, you can see potentially a small rise in yields just from people feeling a little bit less panic-stricken, a little less risk-averse than they've been, and putting less of a premium on those kind of ultimate safe haven assets. And we've seen that playing out a little bit. But in terms of a big rise in yields, I think we'd need to see more significant change on one or two other fronts. We'd need to see interest rates going up. We'd need to see inflation going up markedly. And at the moment, we just don't see those. QE and central bank activities are keeping interest rates locked down low on key central banks, and that helps to cap bond yields for the time being.
So we watch that carefully and wait. Another issue with the volatility as well. This you've been using, which in the past few months have been the use of insurance and using some institutional structures by way of put options in the portfolio.
Yeah, we held put options for a brief period in the portfolio back in the summer, and of course, this is insurance. This was insurance against the risk of a very extreme outcome, particularly around Greece and the risk of a eurozone meltdown. It was never our core scenario. We didn't think it was going to happen. I think we made that pretty clear. But we felt that if it did, the impact was so large that we had to be prepared against it. So we bought insurance. We bought put options. Insurance always costs money, but of course it enables you to hold the other positions you want to hold. So we owned European equity, we owned credit, we owned high yield, which did very well through that period.
And of course you don't have to sell that either if you were the alternative. You've been incurring
absolutely
costs. So it's actually quite
owning the put insurance allowed us to keep those other positions we liked.
Okay. One last thing, Alex. With regard to corporate earnings, I recall last quarter you focused on dividend strategies. Is this still the case? Because you look at slide 18 there, there's some potential upside on dividend futures, it says.
Yeah, we think in most scenarios, corporate earnings in 2013, 2014 are still going to be rising gradually above where they are now, and that's very supportive of company dividends. We bought into dividend trade in Europe, in Japan as well, and of course nothing moves in straight lines, but we still see these as trades with good risk-reward trade-off. We see still more to go for there, having had quite good success with those already.
Well, Ros, Alex, thank you very much indeed for your views on that. I hope you all find that helpful, just going through our current views on asset allocation and where to deploy clients' monies. It's generally feeling generally a bit more positive than I think we've seen over the past few months, but of course there are always risks there. Thank you for tuning into this. I hope you found it helpful. If you'd like any more information on this, or actually anything else we can help you with at Seven Investment Management, then please do either contact us directly or through your Seven Investment Management Relationship Manager. In the meantime, Ros and Alex, thank you very much indeed, and goodbye.
Thank you.
And goodbye from me.